Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KEURIG Dr. Pepper Inc. quarterly report. KEURIG Dr. Pepper Inc. offers a diverse range of businesses and services across three segments: U.S. refreshment beverages, U.S. coffee, and international. The company's product portfolio includes branded concentrates, syrups, and finished beverages, single-serve brewing systems, and K-Cup pods, specialty coffee, and ready-to-drink coffee products, tea, cocoa, and other products, partner and private label brands. The company markets and sells its products through various channels, including supermarkets and mass merchandisers, club stores and e-commerce retailers, office superstores and restaurants, hotel chains, and office product distributors directly to consumers through the KEURIG.com website. The decline of KEURIG Dr. Pepper Inc.'s KDP stock price over the past year can be attributed to several key events. The acquisition announcement of JDE Peet's for $18 billion was met with skepticism from investors, causing a significant drop in stock value due to concerns about escalating debt and integration complexities. Additionally, soaring coffee costs resulting from inflationary pressures further impacted profitability and consumer confidence. A large share offering by major shareholder JAB Holding Company also contributed to the decline, creating an imbalance in supply and demand. These factors combined have led to a 9.59% drop in KDP stock price over the past year. The primary drivers of revenue growth and decline for the company can be summarized as follows. Revenue growth drivers. Net sales growth contributed significantly with an 11% increase from Q3 2024 to Q3 2025. The U.S. refreshment beverages segment saw a notable 14% growth, while the international segment experienced a 10% growth. K-Cup pods revenue grew by 9% for own brands and 18% for partner brands/private label owners. Revenue decline drivers. The appliances segment showed a decline in revenue of 1%. K-Cup pods saw a decline of -4.4%, while the U.S. coffee segment experienced a net sales decline of 0.7% and a volume/mix decline of 4.3%. Net income experienced a significant increase in Q3 2025 compared to Q3 2024, rising by 7%. This trend continued throughout the first 9 months of 2025, with an even greater increase of 9.2% compared to the same period in 2024. The net income growth was substantial, increasing by $141 million or 8.9%. However, profit margins showed a mixed picture. Gross profit margin decreased by -0.8%, dropping from 55% in 2024 to 54.2% in 2025. On the other hand, operating profit margin increased by +0.4%, rising from 22.9% in 2024 to 23.3% in 2025. The reasons behind these changes are not explicitly stated but can be inferred. The increase in operating profit margins is likely due to higher income from operations. Conversely, the decrease in gross and operating profit margins may be attributed to various factors such as acquisitions, integration challenges, unknown liabilities, unforeseen expenses, reduced expected revenues, diversion of management time and energy, and uncertainty about the effect on employees and customers. The company's financial performance indicates a decline in its ability to generate positive operating cash flow. In 2025, the net change from operating, investing, and financing activities resulted in a negative operating cash flow of $45 million. This suggests that the company is struggling to cover its expenses and may need to reassess its operational efficiency to improve its financial stability. The company's debt level and interest expenses have undergone significant changes over the past year. While there were some fluctuations in debt levels, with a notable increase of $619 million in long-term obligations and a 13% rise from $12,948 billion to $14,425 billion, these increases were offset by a $1.5 billion decrease due to the reduction in the bridge credit agreement. However, the most significant change was seen in interest expenses, which increased by +77%, +6%, and +77.4% across various periods. The company's entry into forward-starting swaps also contributed to an increase in interest expenses. Overall, these changes indicate a substantial rise in both debt levels and interest expenses, suggesting that the company is taking on more financial obligations and paying higher costs for borrowing. Management is optimistic about the company's outlook, citing several key drivers of growth. The acquisition of JDE Peet's is expected to bring significant strategic and financial benefits, while the integration of Ghost is seen as a key opportunity for expansion. Management also expects energy portfolio to be a major driver of growth, with benefits from higher net price realization. However, management acknowledges some challenges, including softness in still beverages portfolio and appliance volume, as well as increased costs associated with productivity projects and tariffs. Despite these headwinds, the company remains focused on increasing income from operations and prioritizing business growth, balance sheet strengthening, and returning cash to shareholders. Management's overall strategy is centered around driving growth through strategic acquisitions and investments, while also maintaining a strong financial condition and liquidity. While there are some uncertainties related to JDE Peet's integration, management is confident in the company's ability to navigate these challenges and achieve its goals. Acquisitions and divestitures overview. The company has made several strategic moves through acquisitions and divestitures in recent years. On the acquisition front, notable deals include the DPS merger in July 2018, Callo acquisition in August 2024, and Ghost transactions in December 2024. The JDE Peet's acquisition is also planned to close in the first half of 2026. In terms of divestitures, the company has announced plans to separate its coffee business into an independent, publicly traded company. Additionally, a separation of another business unit is expected, although specific details are not provided. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In the past 2 years, it has paid out significant amounts in dividends, with $937 million paid in 2025 and $883 million in 2024. Additionally, the company has also engaged in share repurchases, buying back over 1.114 billion shares in a single transaction. Concerns about inventory buildup and supply chain disruption are evident in the company's financial summary. Inventory buildup is a significant issue, as evidenced by the 26.5% decrease in U.S. coffee appliance volume due to retailer inventory management on page 47. This trend is also observed in other regions, with a 21.1% decrease in appliance volume attributed to similar reasons. Supply chain disruptions are another concern, with mentions of supply chain issues and the impact of tariffs or trade wars on page 42. The company's income from operations was negatively affected by a net unfavorable change in ingredients, materials, and productivity, 13 percentage points, on page 47, while increased transportation and warehousing expenses were reported on page 51. These concerns highlight potential risks to the company's financial performance and operational efficiency. That concludes the financial summary for KEURIG Dr. Pepper Inc. Feel free to comment below, and I will be happy to answer them when possible.